No drama in that CPI report. Get back to the beach. Live from New York City this morning. Good morning, good morning. Equities higher. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the smallest back-to-back inflation increase in 2 years, leaving the door wide open for the Fed to pause as the president continues his Bidenomics tour. We begin with a big issue, inflation in America.
It's all about inflation and what those data show.
CPI today
will be very important.
Important as the Fed convenes in September.
That's what the Fed has said, that's what they're looking at.
They're trying to figure out what their next move is going to be.
We are in a disinflationary trend.
Disinflationary trend.
We're probably at the Fed and the end of the Fed tightening cycle.
Additional Fed rate hikes are definitely still on the table.
I see more inflation as we head into the back half of the year.
The second half of the year, inflation ticks higher.
I just don't see core inflation coming substantially below, say, 4.5%.
That is very much the elephant in the room.
It's too soon for the Fed to make a call on that September meeting.
We have a lot of data between now and then.
You have another payrolls, you have another CPI.
Friday's PPI reports. A lot more data to come out the next couple of months.
Depends on the data.
Let's get to the panel. BlackRock's Jean Barvan, PGIM's Robert Tipp. Jean, first to you. Your takeaway from that data 31 minutes ago.
Well, I mean, we've seen a streak of numbers, I think, that clearly show very serious progress on inflation for now. I think that, that cannot be ignored. But I would say, taking a step back, and this is what we're going to need to deal with over the next few months, is that we've been of the view this is going to be a roller coaster. I think we're seeing now that the downside of that roller coaster, I think that's going to lead to some way up as well. So maybe amplification of the roller coaster is one of the a story that comes out of this for the next few months. But it is an unambiguously great progress over the last 3 months we've seen.
Robert Tipp, is this the best inflation report of the year? And will it be the best inflation report at the end of the year? Do things get better from here or get worse?
It's a great inflation report. And I would think there could be, more of these and maybe a lot more of these ahead. I share some of the skepticism. I mean, airfares, for example, in the last 4 months are down about 20%. And I think there are areas out there that have upside risk, like energy and housing and so on. But it's not just in the U.S. that you're seeing these numbers. And even in the U.S., it's not limited to inflation. I mean, the non-farm payrolls have had a very steady decelerating trend. And that combined with these numbers, and the Fed is numbers driven, even if maybe they're not a complete match to reality, this is going to really put them on hold and have them asking themselves, gee, maybe we could be cutting rates in 6 to 12 months. And I think one of the things that adds to credibility on these numbers is that we're seeing this globally. Some of the places that were leading on the way up with the rate hikes, like Brazil, Chile, are seeing inflation numbers come down. So it's a phenomenon out there. We'll have to see how much durability it has, but it's good news.
From your perspective, Jean, how much of the improvement we've seen so far is down to the tightening from the Federal Reserve over the last 12 months? How do you identify that?
I think, we've never gone through to this period, this shock. This is totally unprecedented. Very difficult to put, really strong confidence on how much is due to the Fed. But our view is, we're basically living the consequences of two massive shocks, unprecedented. The first one is this pandemic sectoral reallocation, something we've never seen before, both in terms of its occurrence and magnitude. And I think the conclusion we're reaching here is that this has been unwinding, maybe more quickly now than would have been thought a few months ago. So at first it was slow to play out, but this goods kind of deflation is accelerating. You're seeing the normalization happening, less pressure on the labor market coming from that shock. And so I don't think that has much to do with the Fed. I think this is normalization from the pandemic that took longer to play out and now is accelerating. Now, the Fed's going to start to have an impact, and I think this is coming next. And that's the same time as we're seeing another big shock, unprecedented, which is this aging into retirement. Something that the U.S. has never, ever experienced before. It turns out now we're reviewing and learning that it hasn't been really playing up or biting yet. But this is now we're getting to the point where it's going to bite. And I think in terms of the implications for payroll, for instance, they are decelerating, but nowhere nearly as much as what would be needed to bring them back in line with what the demographics are implying. So we should be payroll numbers are about a third of of what they're running right now. So the deceleration is happening, but there's a lot more that needs to happen for it to bring the labor market in equilibrium and avoid, the leg up in inflation that's going to come from these demographic shocks. If we don't see the deceleration.
We're going to build on that in just a moment. Let's turn to the equity market, about 25 minutes away from the opening bell. Futures here positive by 0.75%. The equity market liked the report, the bond market too. Yields lower at the front end by 4 or 5 basis points on a 2-year, 4.76 on a 10-year, in at around 4% over the last couple of weeks. We stay there. We're down about 4 basis points on a session, 397. With more on the data, here's Mike McKee. Morning, Mike.
Morning, John. Well, it's a very happy CPI day for Wall Street economists who nailed their forecasts for CPI. Comes in exactly as expected on a month-over-month basis, up 0.2, core up 0.2, and that pushes the headline up by 0.2 to 3.2% and pushes core on a year-over-year basis down to 4.7%. Jay Powell's favorite indicator, core services, ex-housing, is a little bit higher, 0.2 gain after a flat June number, and 4.1% after 4% in June for the year-over-year. A couple of other numbers out today, and I think my chart is not accurate. It is through June. It doesn't show the latest through July, but basically we saw jobless claims go up on the month to 248,000. That reflects the yellow trucking bankruptcy for the most part. And the real earnings number is good news for people, still up 1.1%, a tick lower than last month, but it does show that incomes are rising faster than inflation. And finally, we have to ask what this means for the Fed. You've been talking about that, and at this point, nothing. I talked about this being the least consequential, most important number, and we got the number, and this is the odds of a November rate increase, and they have not moved at all. They're basically at about 12% for the month of September and 20% for the month of November. So basically the market priced out and is keeping it that way, the idea of additional Fed rate increases, but we do have 2 more inflation reports before the Fed has to make a decision.
Mike McKee, thank you very much. Mike McKee on the latest. There is just this extreme comfort right now, extreme comfort with this idea that incoming information between now and the next Fed meeting will not challenge this soft landing narrative, and this Federal Reserve will skip September. Let's see if the data challenges that. The unknown is after September, into the end of the year, and Jean Bavin was talking about that. Robert Tim, Neil Dutta of Renmac was on the programme with us about an hour ago, and he was really pushing back. He said quite firmly, either you believe that labour markets are a conduit for inflation, or you don't. And the question, Robert, we've got to ask is whether unemployment at 3.5% is consistent with bringing inflation back down to 2. Is it?
Right. Well, I think all these things are right on point. And I think, first of all, you asked about how much of this has to do with the Fed. Central banks around the world hiked a lot, and that has taken the edge off of this growth. And if we're getting a soft landing, and by the way, Jerome Powell was there for the last soft landing, it is going to be, to some extent, owing to the fact that they have hiked and taken the edge off of this. In terms of unemployment rates and the demographics, that is an entirely flexible construct in English-speaking DM countries. I mean, in Japan and China, that's a different story. But in the last year or two, the UK, Canada, Australia, New Zealand, and the United States have had huge increases in foreign-born workers in the workforce. We're talking 5 million people in the U.S. entering the labor force, foreign-born, in the last 2 years, which is as much as the last 10. So, in some places that would hold, but I think that's why the central bankers, they don't hold to a NAIRU, because they don't know what it is. And when you look at how few households are surveyed for the payroll reports, how few businesses are surveyed, you really have to look at the wage numbers. You have to look broadly to see if you're overheating or not. And although labor is picking up strength here, no doubt, you're not really in a worrisome situation. If you were, I don't know that you would be seeing such a rapid deceleration in the inflation numbers.
Well, September and beyond, they've got a decision to make, Sean. They've got to ask themselves, what's the biggest risk for me now? Is the biggest risk holding rates at these levels too long or backing away too soon? What's your assessment of those risks, Sean?
Well, my assessment is that, with the data streak we've seen here, and I guess our view that this is like a combination of two shocks that are unprecedented playing over different time horizon, and one that we've made a lot more progress in handling and normalizing from. I think that now gives them room to hold tight for now, hold tight in the both sense of the term, right? So I think they can sit tight for now for some time. But that's in a tight kind of position, and I guess that increased the odds of now being close to that point. On the other hand, I don't believe that they will be in a position to ease anytime as soon as the market is expecting, which is early next year. The odds of that happening, I think, in this environment are extremely low. We agree that the labor market Nehru concept is a very vague one. They won't be guiding by that. But it is the fact that, by all accounts, you're going to look at a market that looks unusually, tight. And to us, the main thing to track will be employment growth relative to this demographic shock, unprecedented. And we think we're at the point where this is going to start to be binding. So I think they'll put some weight on this, and that's going to lead them to hold tight for now. But I don't think they'll be able to ease as quickly as the market is expecting.
Jean Bavin, Robert Tip, sticking with us going into the opening bell about 20 minutes away. Equity futures here up 0.6%. With your movers, here's Abby.
John, let's start out with some of the winners that are helping the U.S. futures this morning. Starting out with Disney, shares are reversing yesterday's post-market loss as investors look past the second quarter subscriber miss and light revenue to the 4% adjusted earnings beat on park strength. Plus, the company is sticking with their plan to cut costs, specifically around media content, $27 billion for this year versus the norm of $30 billion. Investors seem to like that. Apple up about 0.7%. A possible second update into today, down about 8%, the worst stretch of the year on growth concerns from their last quarter. And some are actually talking about Apple buying some of those Disney assets that Bob Iger was talking about selling. And then speaking of buying, Tapestry is down 8.5%. They are, of course, buying the owner of Michael Kors, Capri Holdings, in an $8.5 billion deal. That represents a 65% premium. And
Abby, thank you. On the latest, we'll pick up on that story around the opening bell. Coming up, President Biden heading west.
Where is it written that America can't lead the world again in manufacturing? Because we're going to do just that. The leading manufacturer in the world.
U.S. inflation in focus as the president continues his Bidenomics PR tour. That conversation up next.
Where is it written that America can't lead the world again in manufacturing? Because we're going to do just that. The leading manufacturer in the world. The plan is to invest in America. We're transforming our country, including by rebuilding America's infrastructure. I'm not here to declare victory on the economy. We have a lot more work to do. We have a plan, and it's turning things around. Bidenomics is just another way of saying restore the American dream.
The president speaking in New Mexico, continuing his Bidenomics PR tour with a final speech coming this afternoon in Utah. The remarks coming amid the smallest back-to-back inflation gains in 2 years. Katie Lyons has more. Hey, Katie.
Hey, John, Biden, in the third state he will have visited this week today, is going to try to make that message again, tie what we are seeing in the economy, manufacturing resilience, labor market resilience, and inflation going down directly with his policies. Things like the Inflation Reduction Act, the CHIPS Act, which had its one-year anniversary yesterday, and infrastructure spending as well. And in theory, the data this morning does support that message from the president. Inflation is indeed slowing in pace under his watch. A few political difficulties, though, for President Biden is that Americans American people don't necessarily seem to think that he is doing an excellent job with the economy. We continually get data out that shows large dissatisfaction still with the president. And a new Reuters Ipsos poll released this week, 49% of those surveyed said inflation or increasing costs is the most important issue. 64% said the economy is worse off compared to 2020. And a minority of people polled are actually even familiar with the same legislation that the president is on the road trying to tout. So that is why he is doing that, why he is going out there trying to get this message out. But clearly, he has difficulty getting it to resonate. And we have to keep in mind that even though data does show that price growth is slowing, prices for many goods that American people have to pay for are still higher than they were in 2020 or pre-COVID. And especially the most visible signal of inflation, gas prices, prices at the pump are about 30 cents higher here at the beginning of August than they were at the beginning of July. And that speaks to that 3.2% core headline figure, not core, that shows those volatile prices that actually ticked up, John.
We're making some progress elsewhere, Kelly Lyons. Other places, not so much. Jean Bavin, let's talk about one, the budget deficit. Have you ever seen a budget deficit this big and unemployment this low?
Yeah, probably not. In terms of the exact combination, we've seen periods where we've seen, pretty buoyant economy, low, tight labor market, driven by fiscal policy and expansionary fiscal policy. But at this juncture, with the debt level that we are at, this is unprecedented. This is part of the, I guess, the medium-term story. I think this feeds into how we should be thinking about the yields outlook, not about the Fed policy rates, but beyond that, 10 years and so on. I think there's going to be more to play out over the next few years in that front. And I think this is also part of what if we believe that the economy is so strong and there's more fiscal coming or continues to play out, that feeds into how we reconcile that with this inflation picture that is so benign.
So, Jean, put it together. Is the 10-year a sell or a buy?
Well, we're underweight 10 years plus, space in U.S. Treasuries. We believe that there is room for the term premium to reappear more. We've seen some glimpse of that, over the last few days. But I would say the most important thing to look at this year is just the sheer volatility that you see in this space. The 10-year yield has been going up and down on a daily basis, we haven't seen really. You have to go back to the 90s and 80s to see that kind of ongoing volatility. And that speaks to me to the fact that despite all the talk about soft landing, the bond market is not embracing it and switches on a dime. And I think to me that raises the question, maybe we're wrongly applying a business cycle frame, soft landing versus hard landing, to something that is a lot more structural.
Robert Tipp, would you take the other side of that?
I mean, I think this is a great point in bonds. I think to some extent it is a roller coaster on the data front, but this configuration of a 5% Fed funds rate and a 4% 10-year Treasury, I think it's going to be pretty durable. I agree there will be a very, very slow steepening of the yield curve. But, to that point of the large budget deficit, it is a loose fiscal environment. That's another contributor, another reason for these central banks to be a little bit more cautious about dropping rates. So the big picture, the trades here, I think, are that while everybody's worried about, get hard landing or getting over that, or is inflation going to come back, volatility is going to come down. These central banks are going to be waiting. You may get a little bit of steepening in the yield curve. That's typically great for financial assets. So I think that's going to be, the fuel for the ongoing bull market in bonds. It started a couple quarters ago. It's just based on being at high yields and earning that income, getting a little bit of spread compression. I think that's going to do it.
Robert, we've had a signal from the committee, from Chairman Powell, and from John Williams, the New York Fed president, in the New York Times earlier this week, that they'd be somewhat uncomfortable holding nominal rates steady as CPI decelerates because real rates would increase. Robert, with that in mind, they're not going to adjust every single month based on where CPI comes in. But from your perspective, what kind of real rate, positive real rate, are they comfortable with holding?
Right. Well, I think it's pretty clear that they feel they are restrictive right now. And they have been very clear. You have to listen to everybody on the committee and see how the data comes in. And they will break in the direction of the team that is getting it right. And I think that's a very healthy process. What that points towards, as you're saying, John Williams, the chairman, if they're getting a soft landing and inflation is really looking convincingly like it is down around target, you know, a year is a long time. 6 months from now, if numbers are coming like this between now, the end of the year, they're going into next year, they could start cutting rates in order to get real rates down towards, you know, they're not going to know what the right real rate is, but they're going to move the nominal rates to try to keep these conditions of strong growth. Because once inflation is in check, then the other objective of the Fed comes right back into play. Are you at maximum employment? And you can never know if you're at maximum employment. They have to start probing again to make sure that they don't let growth slow down at that point.
Jean-Baptiste, final word, please.
I think there's a real debate that is happening right now about what they think is the neutral rate, both long-term and short-term. They're revising their models as we speak. They've published this week. I think there's something coming out again today. It's a live debate. I think there's a camp that thinks that monetary policy is not as tight as you would think because their natural rate estimate is going up. I don't know how much traction it's going to get. I think, to me, like the key thing to watch over the next, you know, many months, 6 months, is what the labor market does and this demographic shock. And I think, again, this is a big deal, hasn't played out yet. And in the picture in 6 months could look quite different once we learn more about how this demographic is impacting the labor market. But it is interesting that Chairman Powell and John Williams and others are now explicitly articulating the scenario under which they might be cutting. I just think, to me, this is now a risk scenario as opposed to central, but it's the weight on it is probably going up from what they're saying.
Interesting. Jean-Baptiste, thank you. Alongside Robert Tipp, to the both of you gents. Appreciate it. Going into the opening bell, 7 minutes away. Coming up, the morning calls, and later we'll catch up with Nuveen Sarah Malik on this equity market. It keeps on rallying, up 0.6%. 5 minutes away from the opening bell. Equity futures positive here. Let's get you some morning calls. First up, Morgan Stanley upgrading Southern Company to equal weight, highlighting the company's solid balance sheet and diminishing regulatory headwinds. Truist downgrading Penn Entertainment to hold. $30 price target, seeing sizable execution risk after its deal with Disney's ESPN. And finally, Stifel raising its price target on Wynn Resorts to $150, expecting demand out of China to remain resilient throughout the rest of the year. That stock is up by 1.6%. Coming up, a subdued inflation print, leaving the door wide open for a September pause over at the Fed. That conversation up next with Nuveen's Sarah Malik. Two-day losing streak on the S&P 500. 20 seconds going into the opening bell. Equity futures bouncing back by 0.5%. This more favourable view of this market endorsed by disinflationary trends continuing in the latest CPI print. The smallest back-to-back gains that we've seen in about 2 years. Equities up. There's your opening bell. Switch on the board and get to the bond market. Treasuries running as well. Down by about a basis point or so on a 10-year at about 4%. What is it about that level at the moment? The 10-year, 4%. Pretty much every single time at the close over the last 2 weeks, that's exactly where we've been. That's where we are right now. In the FX market, the euro showing some strength, the dollar a little weakness, 110.16 on that currency pair, and crude down by 1%, $83, and let's call it 60 cents. About 20 seconds into the session, your equity market looks like this on the S&P, advancing by 0.5%. On the Nasdaq, up by 0.6%. One stock to watch at the open, it's Disney. The company cutting costs and raising prices on most of their streaming offerings. The CEO, Bob Iger, saying important changes are creating a more cost-effective and streamlined approach to our operations. Ed Ludlow has more. Morning, Ed.
Good morning, Jonathan. There is so much news to discuss when it comes to Disney's report, but I think we agree that at the heart of it is cost cutting. You look at EPS in the quarter gone, $1.03, beating expectations. A lot of that demonstration of the work that Iger has done to rein in costs. It's interesting, you look at the shares, we're up 3.8%. I know that it's backward looking, but in after hours trade, we were markedly lower for much of the immediate reaction. Then something on the call changed it, and it really was the financial guidance going forward. So starting with the streaming losses, they were $512 million in the quarter gone, Remember that a year ago, the streaming loss was $1 billion, and executives had guided us that for this quarter, it'd be around $750 million. The commentary from Disney was that those streaming losses will continue to narrow and in an accelerated way going into mid-full year 24. And that cost discipline is key. They also talked about exceeding the $5 to $5.5 billion of cost cuts that they are targeting, going past that target. What the market really liked during the call as well was the content spend narrative. It's going to be about $27 billion, down from previously projected $30 billion. That was seen as a massive positive. The streaming business is always in focus. It did drop from a subscriber basis 7.4% in the quarter gone, missing expectations. That's almost all largely attributable to Disney Plus Hotstar, the brand in India and the Middle East. And you'll remember that they did not renew the India Premier League cricket rights. The net result was that for Disney Hotstar, subscribers dropped 25%. The CapEx guide was also lower than previously guided and what the street was expecting. All told, this is Iger saying we're committed to these cost cuts, and they're starting to show the fruits of their labors in that sense. In terms of what happens to drive growth of the subscriber base, they do see it accelerating into the fiscal fourth quarter, which is the period ending September. But really, it's all about discipline. I know that's a boring story, John, but that is what the market's cheering this morning.
But Ed, to build on that, how much of it was about discipline? How much of it was about the strikes on the West Coast in Hollywood?
Really good question. Go straight to the content spend guide, $27 billion instead of $30 billion. You cannot make or spend on content if you don't have the writers to think about the programs. That was a point of discussion. But remember, I think you and I discussed this at Sun Valley. There are two competing forces when it comes to the streaming businesses that want to be profitable. They're conscious of pulling back spending, but at the same time, you need the content slate to drive the subscriber growth. And I think that, Iger was pretty sanguine that in the end, the writers or actors strike aside, they've got the balance right in what they plan to spend versus added new material to the existing platforms.
You need the content,
and they raise prices
up
as well.
Well, Ed, that's my point.
Sorry.
Do they believe the tolerance is there for higher prices?
Yeah, and 4 red headlines on the Bloomberg terminal in this earnings, a lot to keep up with. So Disney Plus without ads rises 27%, $14 a month, up from $11 a month. But they seem, based on the data they have of those selecting the ad-supported tier and those that are not, super confident that there is enough content there to justify a premium price point. Hulu, ad-free, jumps 20% to $18 a month. So it was a really interesting move by them. It did surprise the market a little. But I go back to what moved the needle on the stock in after hours. It was the financial guidance on spending.
Ed, thank you, mate. Great coverage, as always, on that name. That stock is up by 2.6%. Let's stick with Disney. Morgan Stanley reiterating its overweight rating after the earnings, saying this: Disney continues to benefit from its park segment. This is important, which we see driving consolidated earnings for years to come. This is a real investment positive as Disney takes meaningful but challenging steps towards improving its earnings power. We're higher there by a little more than 2%. Those gains fading just a little bit. Big acquisition this morning in the retail space. Shares of Capri are soaring after Tapestry agreed to acquire the luxury retailer in a deal worth $8.5 billion. Capri's CEO saying this: we're confident this combination will deliver immediate value by joining with Tapestry. We'll have greater resources and capabilities to accelerate the expansion of our global reach. Abby has more. Hey, Abby.
Hey, John. So, yes, the multi-year trend of consolidation in luxury retail continues. As you mentioned, Tapestry is buying Capri Holdings for $8.5 billion. That equates to $57 per share, a 65% premium. And, of course, Capri owns Michael Kors, Jimmy Choo, Versace. Now, the two companies have actually been in talks for months, so this is not truly a surprise. It's more of a surprise, but the stock is clearly surprised given the fact that right now it's up 56.5%, its best day ever going back to its trading history of 2011. Both companies have been building themselves up in recent years to compete with the likes of LVMH and Kering, but the feeling is they were really no match. So now Wells Fargo is saying that because because Tapestry will have its Coach brands and the Stuart Weitzman and other brands that it has, but with Capri, it's now going to also have the Michael Kors and the Jimmy Choo brands, that they are going to be the leader, the #1 player in what they are calling accessible luxury. Plus, China is a big opportunity. Tapestry has been doing great in China. About 15% of their revenue comes from there. For Michael Kors and some of those other Capri brands, it's been closer to 6%. Capri's weakness this year has been blamed on consumer spending weakness there. Tapestry into today up 8%. Again, Capri had been down big. Now they're both basically flat. So it's interesting to see this evening of the playing field here, John. And while Capri is not quite at that price of $57 per share, it's close enough that it suggests folks think the deal will go through.
Quite a move. Abby, thank you. Capri up by 57% in early trading. About 6 or 7 minutes in. Let's turn to the pharma space. Shares of Novo Nordisk falling for a second day after touching an all-time high. The company's CEO discussing the challenges of meeting surging demand for its new obesity drug.
I'm not concerned at all. We want to make sure that patients who start on treatment can stay on treatment, so we will keep restricting a bit the starter doses in the US to make sure that patients can have a good experience. We have all dose strengths available in the US. We are increasing manufacturing, so this is indeed a very, very positive outlook.
Simone has more. Hey, Simone.
Hey, John. Yeah, this is the same problem that Novo Nordisk has been facing ever since June 2021, when its weight loss drug Wegovy was approved by the FDA. The day after, it was the second most Googled item. Now it's still going to have to continue restricting supply of Wegovy in the United States, especially at some of its lower doses, because it simply doesn't have all the supply it needs to meet demand. I mean, we saw from earnings today, sales falling short of expectations, but enormous numbers here. 54.3 billion Danish krona versus the 55.1 billion expected, but the company did raise its outlook for sales and earnings for the year, mainly on the back of these GLP-1 drugs, both for diabetes type 2 as well as weight loss. Its big blockbusters, Wegovy and Ozempic, coming in well ahead of sales expectations. You know, the question here is, one, what kind of competition does Novo Nordisk begin to see from its competitors, especially Eli Lilly, which has Mounjaro, likely to be approved by the FDA for weight loss later this year. That one seen as maybe even a little bit better than the Wegovy option in terms of weight loss. But, you know, it's such a large market. Jeffrey says $150 billion for weight loss drugs by 2030 that it may not really matter. So then if the concern is simply keeping up with the kind of demand, how much is Novo Nordisk falling behind? And how much is this simply where we're seeing a price that's above analysts' targets? The street has looking for 12.05. We're at 12.40 at the moment.
Run it so hard, so fast. Not a bad problem to have when you think about it. Simone, thank you. Let's get back to the earnings. Shares of Wynn Resorts jumping on better than estimated Q2 earnings. The upside results driven by pent-up demand out of Macau. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, currently Wynn shares higher by about 4%. That's after reporting yesterday after the bell that second quarter adjusted EPS came in at 91 cents. Analysts were looking for just 62 cents, so a big beat there. Also on second quarter operating revenue, that came in at $1.6 billion. A little bit of a beat as well. The estimate had been for $1.53 billion. And getting specific, Las Vegas did pretty well, but as you mentioned, it was Macau that really shined. Wynn Macau's hotel saw revenue of over $300 million. You compare that to a year ago, it was below $59 million. And checking in on the sell side, Jeffries wrote that it was the Macau properties that generated the greatest upside to the bank's forecast, and Stifel raised its price target on the heels of these results. And looking ahead, while it wasn't a factor in what we learned yesterday, Wynn also said that it expects to obtain a gaming license in the United Arab Emirates soon. And if that happens, John, that would be the Gulf region's first casino resort.
Katie, the stock's up by 3.8%. Katie, thanks for the update. This market rallying, nothing to challenge that soft landing narrative in the economic data we've had so far. In the last hour, CPI in line with expectations, the S&P up by 0.9%. Joining us now is Sarah Malik, CIO at Nuveen. Sarah, wonderful to have you with us on the program. It always is. This line in your research, you said you are in the lower is over camp. What does that mean, Sarah, after the data we've seen in the last hour?
Well, I think today's CPI number does support a pause for the Fed in September, but the door's open for a hike in November. We generally think that inflation is going to have a hard time hitting its 2% target that the Fed has set. So we see structurally higher inflation and interest rates for a while. We also don't see rate cuts in 2024. The market's pricing in about 3 to 4 rate cuts. Now, two things we did like about today's inflation number was the moderation in these two wild cards of used cars and also other areas of inflation that have been volatile over the recent period. But two areas that we're watching are energy going forward. We think that that's going to become a part of inflation that moves higher in the future, and also shelter prices. Real-time data is showing us that that's starting to moderate. We're hoping that continues to do so. But used car and airfares are two areas of inflation that we're glad to see those down in today's number. But they're very volatile. That's what we've seen in history.
Sarah, what are the factors behind this resilient economic growth we've had in America that you think will persist beyond, say, the summer into next year?
Two factors have been consumer and employment. Employment markets have remained strong. Last July's payroll numbers coming in at 187,000 is still a number that supports economic growth. Consumers have been spending, and that's what's been holding up the economy. As long as people are employed, they tend to continue to spend even during inflationary periods, and that's what we're seeing. As long as that continues, I think then the economy will continue to grow. We are concerned about the employment markets, though. They are starting to show some cracks. If that happens, I think the consumer does slow going forward, and that will get us into a mild recession. However, that is not our call for 2023, but we may see more of that in 2024.
Let's lift the lid on this equity market together and go through it sector to sector. Sarah, where do you think in this economy right now there is still pricing power for these companies?
Yeah, we're seeing pricing power. Margins for this quarter of earnings are actually holding up much better than people expected. We're seeing companies hold on to pricing while getting the benefit of lower inflation in their cost basis. That's good for margins. But earnings have been interesting in the sense that about 3/4 of companies have beat earnings during the second quarter by a rate of about 7%. But stock prices are not reacting positively to that. Stocks are actually down, having the worst reaction to positive earnings that we've seen in about a decade. So that's not great for earnings. That's showing less health for the markets. The leader being technology, which now has been very weak, trading at about its 50-day moving average. We'll see where it goes from here. But tech stocks really just have not been reporting earnings that are good enough to please investors, given the stock price run that we've seen this year in that sector.
We've had so much multiple expansion, Sarah. Where are you expecting the earnings growth to come from?
Well, most of this year has been driven by valuation expansion, and that's been the issue, is that how much further can earnings go? We're already seeing margins hold up well. Pricing power probably is at risk as inflation starts to decline and continues to decline from here. So I think that's the issue. If earnings cannot continue to grow, I think valuations for the markets are at a premium. We're going into, we're in the second half of August here, where liquidity tends to be light. I think market moves will be exacerbated. Some of the things I'm worried about are earnings where we're not seeing a healthy earnings market in terms of stock prices. Also, the Moody's downgrade of banks, I think, and their credit ratings is an issue. Energy prices going up, that's inflationary. And even China trade data came in poorly. And then finally, you touched on it earlier, the 10-year is at 4%, and that's a headwind for equity. So with valuations where they are, there's a handful of headwinds for equity going forward. So I think markets at best are in a trading range and maybe even are at a short-term peak at this level.
This sounds super defensive. So final question, Sarah. Top picks, where are they right now for you?
Top picks. Yeah, I mean, one sector we like a lot, it's not a sector, just a category, is dividend growers. These are stocks that have underperformed year to date. They're companies that tend to grow their dividends. They're resilient in down markets. They have nice up market capture, but they don't perform as poorly as the markets do on the downside. They've lagged a lot year to date. Many tech companies don't pay dividends. So this sector's been left behind. I think this could have a catch-up trade if the market turns more defensive because of these headwinds that we talked about.
Sarah, great to get your input on the program. Sarah Maliger, thank you as always for jumping on with us on a busy morning for everyone. About 15 minutes into the session, equities up by 0.9% on the S&P 500. Coming up, investors digesting the latest inflation report.
I think the reacceleration story for inflation, it's really about, in my view, is the economy growing above trend or not? And I think the economy is growing above trend.
Neil Dutta thinks this can continue. Team coverage up next.
I think the reacceleration story for inflation, it's really about, in my view, is the economy growing above trend or not? And I think the economy is growing above trend. I don't think the Fed has done enough. I do think that there is a risk that the Fed is kind of patting itself on the back by the end of the year, only to watch inflation potentially turn back up, sometime next year.
Neil Dutta of RenMac, I don't think the Fed has done enough. Those comments coming after a subdued inflation print in America about an hour ago. Core CPI posting the smallest back-to-back increase in 2 years, leaving the door wide open for a Fed pause in September. Let's get to the team coverage. Bloomberg's Mike McKee, Ira Jersey joining us from Bloomberg Intelligence. Mike, first to you. That thesis, that argument people are presenting at the moment, the prospect that inflation can re-accelerate.
Yeah, let's run through this a little bit. On the Bloomberg, if you have a Bloomberg, you too can be a quant. We have a great program called ECAN, which breaks down all of the information in these economic releases into little bite-sized pieces you can see. And the first thing I want to show is what's happened up to now. We're seeing basically a trend that looks very good of not only inflation falling, but the contributors to inflation getting smaller every month. The only thing that really changed in the last month is the red there, energy, a little bit less of a subtraction from CPI, but everything else looks like it's getting better. But that's not what some people in the markets are seeing, and I'm sure Neil Dutta is thinking this too. You look at inflation forwards, five-year forwards, and what are they telling you? They're telling you that people think inflation after 5 years or over 5 years is going to be going up again. That has turned around in the last couple of weeks as financial conditions have eased, which is a real concern. And then what you have to look at is the yield curve, and you've seen that, John, invert in great detail, and now it's starting to go the other way. And the thing is, recessions don't start until the yield curve uninverts and the Fed starts cutting rates. And so is this a dangerous moment? That's what the Fed has to decide.
That uninversion, if we can call it that re-steepening, Ira, led by the long end. Usually when you're going into recession, it's the Fed cutting and you get this bull steepener with the front end rallying. It's been the long end selling off. Ira, what do you make of that over the last, not just this morning, the last month?
Yeah, so really the last couple of weeks, it's been a big part of the supply issue that you've seen the long end start to creep higher and versus the short end. So usually bear steepening, like you've seen over the last couple of weeks, usually does not persist for very long periods of time, and I wouldn't expect it to this time as well. We have supply. We had supply yesterday, 10-year auction. Today we have a 30-year auction. I think after that, the supply story won't persist until, of course, we get additional supply next month. So we're in a situation right now where everyone's trying to do exactly what you're talking about, John. Will inflation reaccelerate? So there's a part of the market and a part of the rates market participants that are suggesting that we could see a reacceleration of inflation. So what does that mean for the curve? I think from my perspective, the single biggest thing that the Fed needs to do is try to get some of the cuts priced out for next year, because those easing of financial conditions that Mike just talked about is in large part because the market is still expecting interest rate cuts next year. You price those out, and that's just as good as hiking in November if you say don't have a hike until the second half of next year.
Well, the Fed is entertaining that conversation to some extent for 2024. Ira Jersey, thank you, sir. I wanted to squeeze this in again. Mike McKee, happy birthday. We love you. Have a great day. Thanks for sharing your day with us on Inflation Day in America. Let's get you some sector price action. Here's Abby.
Well, stocks are higher on Mike McKee's birthday day, a real risk-on mood, maybe celebrating, up more than 1%. And we have all the big tech, mega-cap tech sectors really rebounding here, John, up more than 1%. The worst sectors are utilities, real estate, and industrial. So utilities, of course, defensive. So that is risk-on that they're underperforming. As for one interesting area, the overall solar area is higher, up 1%. But you can see Plug Power absolutely plunging, this as gross margins disappoint.
Abby, thank you. Your trading diary up next. We've made progress while maintaining a strong economy. The words of the president in a statement from the White House just moments ago following the inflation report, a disinflation report over the last couple of months. Your equity market doing nicely, up 1% on the S&P. That's the price action. Here's the trading diary. The US Treasury selling another $23 billion in 30-year bonds at 1 p.m. Eastern time. Shortly afterwards, the president continues his Bidenomics tour with remarks from Utah. Atlanta Fed President Raphael Bostic, Philly Fed President Patrick Harker speaking this afternoon. And finally tomorrow, rounding out the week with US PPI and the UMich Consumer Sentiment Survey. From New York City, that rounds out the morning for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.